Hey, John.
What's going on?
So let's start off the session maybe by educating some folks on your role and Avalanche. You have a chief business officer at Avalanche. Tell us why Avalanche is one of the biggest blockchains out there and why it's a great fit for real-world assets or RWAs like Domainians.
Thanks for having me. It's good to be here with you all today. So as I mentioned, John Nahas, Chief Business Officer at Avalanche. So we work on behalf of Avalanche, that ecosystem. Been there 5.5 years now, which is a paternity in my space. People usually churn pretty quickly, but I've been there since the beginning, before the chain went live in September 2020. And been here this long because I really believe what we're doing. So to give you kind of a comparison, so which I think would be helpful for a lot of people here. For those of you that have heard of Ethereum, it's a chain, and it's kind of like there's layer 2s on top for general purpose transactions, and now there's been speculation for layer 3s, etc. And so think of it as an inverted pyramid. Reason being that it didn't know what it was being created for in 2017, right? Since then, we've seen the emergence of more and more blockchains, some faster, some cheaper, some more decentralized, some niche, this, that, or the other. The current state that we're in right now, I'd like to call it the big pipe theory. So you're going to hear from Solana tomorrow, and you see Aptos or Sui, which came out of Meta. These are kind of infinite growing pipes, shove everything through it, everything alongside each other. Avalanche is different in the sense that we have our own blockchain that anybody can build on, anybody can use, it hosts all your assets, but also the ability to spin up your own blockchain as well. So your own purpose-built blockchain, application-specific blockchain, business or jurisdiction-specific or compliance-specific blockchain. We believe that the future is multi-chain, but that for this technology to grow and flourish, it needs to be application-specific. It's a tenth of the time. So right now, as the current status is, if you want to build an application on a blockchain, you have to fit your business, application, or asset onto that infrastructure and what that infrastructure allows you to do. With us, it's kind of the opposite. It's like you can build on us, or you could build a chain that services your business for the needs that you need. So I think that's a big differentiator that we have.
And you've been a pretty outspoken critic publicly around saying crypto, as a lot of crypto has been tech for tech's sake, right? And common word that we all use is tokenization. How have you observed how Web2 stakeholders view tokenization differently than maybe Web3 in general?
Yeah, I mean, I have been critical for the simple fact that this space has been around for 10 years, despite how kind of supportive this technology should be for financialization of any asset stuff. We've yet to really find a killer app, aside from maybe stablecoins, which are effectively digital dollars. And a lot of new blockchains over 2 years, right, keep popping up. I mean, there's huge billboards on this building for Ripple. Nobody has solved any real business problems yet. I think we have had a elitism problem in the industry where we like to make it difficult to enter and difficult to use Web3 products or crypto products because we like the jargon. We like thinking that it's something special. But at the end of the day, technology and infrastructure exists to enable business use cases, right? Like if you're building tech for tech's sake, which crypto people do, you don't really have a product. And most of these platforms' products have effectively just been the tokens, right? You build a blockchain, you launch a token, you use that token to go find people to use your blockchain. So it's kind of cyclical, and you just keep renting people out. I mean, when it comes to Web 2 or domains or any kind of industry, really coming on chain just makes your business better. Like, so for us, we work with the biggest institutions, banks, enterprises, you name it. And our kind of North Star has become better business. Blockchains enable businesses to make money through new opportunities for monetization that were previously available, or by improving operational efficiency, right? Saving money. That's a great way to do it too. Tokenization is just effectively a digital wrapper, right? So as like Web 2.0 allows for the free flow of information, Web 3 and crypto really should be the free flow of value. And by tokenizing things, and tokenization is the buzzword nowadays, it just means putting a digital wrapper and allowing rules to be enforced at the programmatic layer for things to sell instantly or near instantly, 24/7, 365, without having to deal with intermediaries and rent seekers. And so for us, kind of working with Web 2 and with enterprise institutions now, more so than like, hey, come let us tell you how great crypto is and why you need to go through these hurdles, is more so the backend plumbing, right? So every user account is effectively a wallet. Every dollar is a stable coin. Your yield is generating passive income, or generating yield through DeFi, or different volatile protocols. And you can digitize or tokenize any of these assets, whatever it may be, and have to be tradable or fungible or whatever it is.
Speaking of tokens, a lot of the crowd here today is very retail centric. And you've been through many cycles now, both bull and bear, around companies, individuals, products launching tokens. But launching a token is also very different, right? Because the buyer universe is very different. Can you tell us a little bit more about what makes a token successful and what you see on Avalanche, right? And I think a lot of the analogy that Web2 makes is that they're just like stocks, right? Well, stocks trade very differently, and tokens have traded very differently historically. What are the key differences in your mind?
So I think for the longest time, we couldn't really define what a token was because we had no regulatory clarity. We're getting closer to that right now. But they're not equity, right? So they can't really trade like stocks. Like, I see people make comparisons daily, like, oh, this blockchain generated X amount of revenue through fees. That's not really, they're not really generating revenue. The tokens are there effectively as a network currency, or the currency platform to allow transactions or things to be done on the platform. They're almost like the oil, right? Or the commodity that runs that platform. The fees or things generated on the platform could not really roll back to token holders because of potential regulatory issues in the past. I think now we're in a space where there's more creativity being created around what tokens are, why they exist, what value they actually have, both inherently or what rights they impart on the token holder in order to receive a yield or a dividend or a payment, or maybe nothing. With that said, I would say about 95% of all tokens that have been created to date have absolutely no need, no use case, and were just a speculative asset for the sake of speculation.
So the 5% of tokens that are created have to create net new values when you're sitting aside from being more accessible.
You either have to create value or allow access to value, right? So like, or access to something, or like if you want to deploy a application, you need to hold a certain amount of tokens or lock up a certain amount of tokens. Like, there should be a purpose for its existence. On layer one blockchains like ours, I mean, you need those for proof of stake. So you need to buy and stake tokens to run a node, to run a decentralized network, which also marks on you yield from the network as a reward for doing so, right? Say with Bitcoin, right? If you run a miner, you get paid in Bitcoin. Like, these things exist for that reason. It's hyperliquid. I know Fred was talking to Charlie about this before. Every dollar generated in fees on hyperliquid goes back into buying the token. So they're removing supply, so effectively like a buyback. But 90-something% of tokens exist for the sake of just existing. They were an easy, quick way to raise money for a product that a lot have not monetized, and others do monetize. That's the equity layer separate to the token layer.
And Avalanche particularly has a very strong presence in the institutional side, especially with real world assets. What other RWA markets are you guys involved with aside from domains?
Geez. So I think we were one of the first to get tokenized fund from a major issuer. So KKR issued a major fund on us 3 years ago. Paula has a fund on us. BlackRock has a fund that's tokenized on us. Right, plus Templeton. We worked with Tiro, Wellington, Citibank, JP Morgan, Hanwha Bank in Korea, Miri Asset Management, name it in Japan. So in the Middle East, in the Kingdom of Saudi Arabia, working with a consortium based there, the UAE, I mean, it's kind of everywhere. So our kind of premise from day one, Avalanche was built from the ground up to service kind of the North Star of the network, which was to tokenize the world's assets. So effectively digitize everything of value and allow it to live on chain. So that's where the customization comes in. That's where the necessities that come in for jurisdiction or complying for application for assets, specific use cases have to be built with that world in mind, right? I think the early days of crypto were a little, it's a nice term, kind of against the system, which is fine. But look, like, I think if we think about it for a minute, like, Uber can disintermediate taxi drivers, Netflix can kill Blockbuster. But when you talk about money, money is backed by governments. Governments have RPs. Like, you're not going to revolutionize the way money works and value works from the outside. You do it from the inside and force that. So the innovation that we see in DeFi or decentralized finance applications is actually what we use to go show incumbents and financial institutions how things can be better. It's not check.
And you guys, I recall you guys made an announcement that you could partner with Toyota or Honda, one of those manufacturers in Japan, to tokenize. What does that actually mean? What did that deal look like?
So this goes back to like the thesis that I said, right? Like, you'll hear a lot about this blockchain is for Bain, so this one is for this, or one blockchain can do everything. Well, that's not really what works, right? That's like saying you can only have AWS without having Google Cloud, GCP, and Azure, and Bare Metal, and a million other things. Like, the world doesn't live off one rail. So that's really good marketing talk for something that you find it from that, frankly. So Toyota came to us and they wanted to put mobility on blockchain to improve efficiencies, unlock things that are usually slow or convoluted or have interdepartmental fusions. And they said, look, we want to build this thing and we're going to need our own blockchain. And in fact, their technology team at their innovation lab said, for what we need to build, we actually need 4 blockchains. So one blockchain to register cars with their VINs, one blockchain to register parts, one blockchain to register the production of the parts and the cars and the kind of the supply chain, and a 4th blockchain to connect all of them, because each one has its own function and you need one that connects them all together. That is antithetical to how the current crypto or blockchain world exists, because to them, everything should sit on a blockchain and blah, blah, blah. That's how the world is. So that's a perfect use case. I mentioned Saudi Arabia a minute ago. We did something there too. We're working with the government authorities there to launch something for settlement with trading between banks in Saudi Arabia. The government's request was that every single one of the nodes that run the network have to be with the Keto. The servers have to with the Keto. We said, we can do that. Well, let's do this on any other blockchain, right? Like, the flexibility to build what you need for your use case is how it differentiates us.
I know it sounds intuitive for you, but for the non-crypto folks in the crowd, how do blockchains make money, and how do you guys align your incentives with the partners that you work to bring on cheap?
So that's a great question, because people always ask me about this differentiation. So as the network itself exists to really just be an infrastructure layer. So token holders are not affected. They're not really equity holders of the network. They're more participants. But what we have not seen to date is a correlation between network activity and all of these things tied back to the token, because for the most part, people who created these tokens could not ascribe direct financial value to that or explain why, because of fear-based security. Now the CFTC, the SEC have come out and said these are commodities, they are not securities. So you're seeing reworkings of how tokens are structured to do so. Us at All Labs, separate from the token, the network side, do business in this. So we have a product called Ala Cloud, which is effectively blockchain as a managed service. So if you're an enterprise, institution, or business and want your own blockchain, I mean, most teams raise, Charlie's old fund probably gave hundreds of millions of dollars to teams of 10, 50, 100 engineers to build complex, decentralized, distributed blockchains. Well, it's really not that hard anymore. I mean, the technological improvements are incrementally getting better, but there's no demand for all of that. So what we do is we can spin up a blockchain for you. So one, people take for granted the work that goes into building a blockchain. 2, launching it, make sure it works. And most importantly, 3 is the maintenance, the continued updates and upgrades that happen at the token level, the protocol level, and all these other things. So we have kind of like an AWS or a GCP, but for blockchain. So you come to us, we spin up a blockchain, you get an SLA and a managed service contract, and we just take care of that for you. We'll progress alongside with that, that people can use. We have a privacy solution that shields financial transactions for institutions that we sell as well. So there's the businesses that are built on blockchain, which we are, right? So like, we built businesses on our own blockchain. And then there's the blockchain side too.
That has a very powerful institutional value proposition. Let's pivot a little bit to the retail side, right? So the retail folks here, Avalanche, as one of the largest blockchains as well, just alongside Solana and Base, you've had your fair share of tokens launch. There have been meme coins, there have been other tokens. Walk us through the psychology of a trader on your blockchain. What do they look for? What do they want? And how do you think they should think about RWA tokens differently than, your other, dog would have, or there's an index equivalent that I believe token belts launched at one point. How should people think about evaluating RWA tokens, especially as the market matures, as new products and platforms become accessible on Avalanche?
So I'll address meme coins first real quick, because I've been a huge skeptic. I get the fun part of it. Like it's fun, it's speculative.
It's easy.
It's easy, it's fun, there's nothing behind it. But when you take that amount of speculation to its maximum extreme, which is where I think we were last year as an industry, because this goes back to regulation. When you couldn't build things of value without being kind of in jeopardy of getting in trouble or having guys in flat jackets kick down your door, the SEC come after you and make your life miserable like they did under Gensler, and you can't innovate and build really cool stuff because rules don't exist. And when you ask for rules, they tell you there's no rules, but follow the rules. It was just confusing. So people always wanted a place to go speculate. So if you couldn't build things of value, people went to things that literally specifically had no value and just speculated on it. So it's kind of like a lottery system. I look at that negatively because I think it took out a lot of money out of this system. Because you keep rinsing through new kind of groups of retail investors. Some make it, everybody hears about the guy that turned $1,000 into $5 million. Fantastic. But for that guy who made $5 million, how many thousands or tens of thousands lost 100 or 1,000 or 5,000 or more? We're not really building kicks of value. So I think that took away from that. That took liquidity, that took attention, and trust out, just like with NFTs, the cycle previous to that. I mean, I think the best thing you could do on checking this, now we're seeing, Hyperliquid and all these other things. There's perpetuals. You can vote. You can go and trade equities or commodities or stocks or whatever with leverage in perpetual contracts. Perpetuals were something that was born to service the crypto industry. So you could do that on chain. And with the money that you make, you can loop it and earn a yield that's higher than you're going to get at a bank or a money market fund or anything else. I think now, especially with tokenization and with the real world assets coming on chain, something big that's being talked about is RWA looping, right? So if you have something that's generating 5, 7, 8% yield, that's relatively stable, you can borrow against it somewhere probably at a lower rate, and then loop it and build strategies upon that. So there's a ton to do if you want to do it. I mean, the problem is, I think a lot of times people look for that kind of, I made it, one trade and to move on. You get lucky. You could get lucky. I don't think that's really long-term gonna work. And I think if anything has been sidetracked to what we've been doing long-term.
What kind of volumes are you guys seeing on Avalanche today? Which categories, type of tokens are most successful and the yield profile?
So we have, I would say, the second largest Bitcoin product on Avalanche after Wrap Bitcoin. Wrap Bitcoin is something that sits at a custodian and they give you a representation of it on another number of chains. With us, it's not custodial, so you can bridge Bitcoin onto Avalanche, hold it yourself. Nobody has the keys. Nobody controls that. There's no hacks to worry about there. So Bitcoin trades a lot on us. Yeah, Ethereum trades a lot. Of course, AVAX trades a ton. It's probably the biggest pair. There are some new points and some other things, but right now, I mean, we're seeing a large surge in BlackRock's middle. So corporate treasuries are holding tokenized T-bills and money market funds on Avalanche. Franklin Templeton's Benchy, same thing. A lot of money markets are really starting to come on. So what we're seeing is with a lot of corporate partners, a lot of them are holding their treasuries on chain because of how quickly they can send and receive and earn yield there.
And for all the domainers, the crowd, these folks have held very, very valuable assets for the better half of the last 20, 30 years. And they're looking to bring their assets on chain. How should they think about accessing the crypto markets, right? The retail user base. Do they have to do something differently, market their assets differently, bundle their assets differently? Any advice you'd give?
Yes, and I'll come back to that in a second because I'll use another example that I've always said before. People are like, oh, we're going to tokenize real estate. It's going to come on. chain, or if we tokenize it, it'll come. I think Charles also mentioned this earlier, and I think what we've seen for the longest time is two sides of the equation talking over each other. So crypto people have notoriously said, oh, if you digitize something or make it a token or make it fractionalized or tradable, everybody will want to trade it. Now, some things people just don't want to trade, right? So crypto people talk over that group. And then traditional people go, well, this thing is, not the best asset or doesn't trade, but if we tokenize it, the crypto people will trade it. The crypto people, we don't care about this either, right? So I think what you've historically seen is people just assuming if you tokenize something and put it on chain, people will trade it. As crypto people will trade anything, they might not, and vice versa. So the advice I would give is, first and foremost, educate people, right? Like, I've been hearing all this talk about, today about like domains. You guys all buy and sell domains. Well, this is a digital first product, right? So it should be trading digitally. It should have that same ability to trade as any other asset on chain does. So it's a natural home for these things to trade and to remove the friction. I would say, we saw this happen with the metaverse where people are like buying land that it makes believe think like domains are real, that businesses are built on domains, the domains matter. So these are actual things of value that should be traded and tradable at a faster time. So I would educate people. I don't think people realize the size of the market and the ability of the market to kind of move, especially with the entity of domains and a million other things.
Right. Well, what are the ways they can educate folks in the context of a Web3 environment, right? Obviously,
Twitter
with
X or whatever.
With Web1, you could do ads with traditional, the main channel, your aftermarket, blog posts. What are the ways that crypto buyers, where are they accessing information? How are they looking to get educated?
He'd say it's mostly on X, right? Like, so if you're buying and selling domain, or you want to educate crypto people, making your voice heard might be the best, right? Writing content, generating content, educating people, and then tying it into like the crypto stuff, right? Like, oh, why are you guys flipping NFTs? You could be flipping or buying domains. Look at these domains that just sold today. Like, look at this domain. It just sold for this much. Someone bought this domain for this much. They sold it for that much. You just have to provide people with the facts and the data and show them what's possible or what's been possible so far, and then show that what could be possible. And then they can just take it and run with it. It's a really untapped area, and especially the work you guys are doing. It's a perfect place it's a perfect industry to really tap into.
And John, most people know Bitcoin, they know Ethereum, maybe for Solana. Some understand Avalanche, but maybe not the technicals. What's different about the Avalanche architecture?
So, I like to say that, I was saying earlier, like Ethereum, this inverted pyramid, the way it's set up, it didn't know what it needed to be built for. And Solana is a super fast pipe that just ever expands, right? Avalanche is like a highway. We have our lane, and we can add as many lanes infinitely alongside of it as possible. The analogy that I like to do, and I've been saying this for a year and a half now, is I like to think of like the Solanas and the Ethereums and stuff like the early days of the internet, like AOL, right? You used to log on to AOL, and on one page you would see email and chat, sports and finance and games and everything on one page. Everything lived alongside everything else on one page, right? And then WordPress and websites and domains flourished. And now everybody has a website. If you asked me, or if I asked you a few 20 or 30 years ago, do you need a website? You'd look at me like I was crazy. Like, you're not a bank, you're not an institution or a university. Why would you need a website? Well, nowadays we take for granted, right? Especially you all here know the hour of domains that any small business has to be, present online. Anybody can kind of monetize their voice or image to a blog, or launch a business, or launch an identity, or launch anything by having a website. Well, it's kind of the same with a blockchain, right? And not everybody needs their own blockchain, but the blockchain is the value transfer layer that goes on the website layer, right? Like, websites should be able to talk to each other and transfer value with each other through a common rail. And that's what a blockchain really is. It allows for the value. So I look at Avalanche as kind of like the WordPress or the Shopify movement, or whatever analogy you want to use, that's proliferating blockchains, because let's face it, JP Morgan, Wells Fargo, and Citibank, every single major bank is going to eat their own blockchain, because they're going to want their own ledger, their own rules, right? And different jurisdictions are going to need their own blockchains. And eventually, if I pull that string out to a theoretical future, I would envision each and every one of us one day when it becomes super easy and cheap to have our own blockchain. So I would have a chain that belongs to me. Maybe it'll be Nahas.avax with the domains that are coming, right? And on that blockchain, I can hold my identity. So my driver's license, my passport, maybe my college certificates, maybe my medical records, maybe my home deed, whatever it is, all live in siloed wallets, segregated wallets. Some wallets are, shielded, some that are not. Different accounts. So instead of a bank, my account at Bank of America and Wells Fargo are all wallets, right? So those wallets can sit on my chain instead. And a financial institution can just validate that. So you can start to think of what's possible to proliferate blockchains in the same way we proliferated websites and allow that value to you.
I know we're running out of time. I want to end maybe this panel by asking you your predictions on the state of the industry. I know the pricing bubble in crypto has relatively popped, but on the institutional side, on the developer side, we've seen a continuous amount of effort, a lot of passionate people. Where's Avalanche headed in 2026? What do you think about the state of the industry with all the global events going on, macroeconomic, geopolitical, etc.?
I don't know what's going to happen geopolitically over the next year. If you get things are less they get resolved, if you get better, I think liquidity's been pretty tight. I think if there's easing, things like that, things will move. I think crypto was a very speculative asset for the longest time. And this recent kind of repricing, I think, is much needed to wash away all the noise of the last 5-6 years. I think this is the end of the beginning of crypto for the last 10 years. And now you're really going to see the professionals, the innovation side, the things that matter move forward. So on the speculative side, you still see a hyperliquid, which is crushing it. Absolutely making a 490 million with 11 users. It's 11, it's members of the team. It's absolutely insane. So I think new things, new innovations are going to come out, are going to get priced higher. I think teams and infrastructure and technology that is delivering real solutions will reprice higher and do better and be valued for what it is, because now we can actually ascribe true value to what they do and what they provide. And a lot of the attention is going to go away from everything else. I mean, Charlie was talking about polymarket. There's a great report that actually came out 2 days ago that pretty much said that prediction markets killed the altcoin market. And anything aside from Bitcoin has been down significantly more than Bitcoin, because people are not speculating on random tokens and what they could or could not do. For the longest time, crypto headlines drove token prices higher, right? If I did an announcement that I'm working with BlackRock, token go up. That doesn't happen anymore. And I think that's a good thing, because that shows that, okay, great, we're working with BlackRock. What does that mean? Let's see where the results are, right? Now, of course, people price things higher based on future earnings or future benefits. So that's good. But the age of the headline-driven speculation is gone. And I think we're going to start to see a true dislocation between the projects and the teams that matter, that are delivering solutions, and everything else will fade into relevance, because on the speculative side, prediction markets are just fun.
That's right. Do we have time for 1 or 2 questions?
Hey, depending on who you talk to, someone might say UOL was better. You had one place, you logged in, it wasn't, right? But it took a while. Even today, if you think about it, identity is not solved on Web2. A lot of this room comes from a very traditional Web2 background. Can you just talk about how are you going to onboard the next billion people on chain with maybe million blockchains existing in parallel, people not understanding looping, shielding, any of the crypto clusters? But how do we make it more welcoming to this audience right here?
It's a great question. So before we get 1,000 blockchains, like I was saying, we need billions and millions more users. There's a report that came out that said, truthfully, there's only 12 to 15 million active users of crypto, people who are doing things on chain, Web3 native, right? Who log in with their wallet and connect and do all that stuff. This goes back to the elitism problem. Crypto people love building tech for tech's sake and say, if you don't understand how we operate, that I don't have time to that's not transforming financial systems and changing the way money works. So I think kind of cliche answer for you that people in crypto don't like to hear. It's they can use crypto without knowing they're using crypto. Make people's lives better and easier. So I'll give you real tangible examples. So Our North Star now is better business, right? As I mentioned, and it's, new sources of monetization or operational efficiencies and save money. So you fintechs and neobanks, things that are popping up, can be digital native from day one. So I'll give you 2 examples. We now run the Cleveland Cavaliers and the Detroit Pistons loyalty programs. They are in conjunction with a partner of ours called UpTop, which does loyalty and rewards, and Rain, which is stablecoin-backed debit cards. So if you log on to your Cavs app, right? I'm a Cavs or Pistons fan. I spend money in the stadium, or I go to a local merchant that that's an affiliate of the program. And if I spend $100 there, the Cavs get $10 kicked back. Well, all of these things are now automated, and they just happen in real time. Then they'll wait to settle at the end of the month, etc. But more importantly, the fan now earns a Cavs point. And every one of these Cavs pubs, by the way, so you load $100 onto your Cavs app, like with the Starbucks app, right? That's stable. Your account is a wallet, right? And if you're holding that, you can maybe decide to earn yield on it. And then that money automatically gets put into a pool of DeFi and generates yield back to you to know. Like one click, like an AV, like, yes, I want to earn yield, right? This comes with risk. Okay, cool. You take the risk, you get the yield. But more importantly, you spend that $100 at a local restaurant. The Cavs get $10 back. You get 100 Cavs points. Well, you have these Cavs points or tokens, but we're not going to call them tokens. They're just points, right? Just like a Starbucks point. Well, now you can redeem those points for maybe a picture at halftime at midcourt, or a picture with the coach, or early access to tickets, or. So the Cavs are monetizing. The fans are benefiting. And this is all being done and orchestrated on-chain in real time without anybody having to push buttons and send and receive money. So those are real-world use cases that we're doing. We're doing this Cavs, Pistons, and LSU. Right now, we're powering those. That's across the board. Soon, Toyota drivers, hopefully, each car will have an associated wallet. And then you can start to kind of cross-sell and cross-connect rates into that. Your car wallet can make you hold a balance that when you drive on a toll road, it just pays the toll. I just bought a new car. This thing was already built into it. Like, I don't have to have the little transponder things. Well, IoT, connected devices all should have wallets. And these wallets can have balances and all pay for each other. And with agentic payments as well, too, there's a lot to happen.
John, I was going to ask you about passing distance, but since you went there, I'll go a different direction. You mentioned in passing driver's license on chain. Am I correct in thinking like California is already bringing their license on chain via Avalanche? Is that right?
The California DMV does have blockchain on us. It is not public for production, but it's for their database and their records right now. So every car registered in California up until last year has an NFT of that car, that VIN number that lives on the DMV's chain.
So in my brain, it's like inevitable that just goes across the country eventually. Would you agree, or what's keeping it from happening nationwide?
You ever worked with this thing to California? I'm not. Let's not repeat this part. We got that news out. Reuters covered it. It made such news. Our president was supposed to go on CNBC with the director of the California DMV, Steve Florida, that day, and their press team called and said, we're shutting down all further press on this. And I was like, but this is fantastic news. Why are you shutting it down? I quote, we're the California DMV. We don't do good news. It will draw attention to all the other projects that are over budget, over schedule. So this is the state-by-state problem. So if anyone's ever dealt with money transfers, you might need to have a money transmitter license in each state. The only federal one you could do is getting a bank charter, right? So it's like impossible step up. Same with DMV. But yes, ideally, in a perfect world, every state's DMV would have their own chain that would report that you could easily move that asset between. The goal for California was that when you logged out to the DMV, your name would have an account, and that account behind it is actually a crypto wallet, and that your VIN number in your car is actually an NFT. So that when I sell you a car, instead of money, you go into the DMV, you could just sign transactions on your website, and then it could automatically happen within a day rather than 2 to 3 weeks of you getting a piece of paper mailed to your house that you probably lose if you're like me. You just want to go back and get it. So
I'll stay inside to get it. It took me literally 3-4 weeks to get a title.
So this goes to better business, right? You can automate so many things that currently exist that are still paper or analog or gated or like across the board. you could just digitize things. So if you add your ID, let's say, right, on chain, you can have that shielded so that if I go to bar, instead of showing the bartender my ID, I can scan my ID, or I can scan something through NFC or whatever technology you want that verifies my age. If I want to go onto a website, it's already built into my browser, my wallet, that I'm over 21, or I'm a resident of California, or I have a college degree. You can start to think how these things can be kind of enabling other functions if they're all digitized and they all talk to each other.
I'm like, one more question. I think you mentioned this, like, what is the token itself is becoming a little more clearer. How do you see the crypto regulation landscape change, especially being on the forefront of RWAs institutions? What's exciting you about the next year? What's scaring you about the next year about regulation?
Yeah, so a few things there. Previously, the term token just started having a bad term. Like, a token is literally a digital wrapper or something that is either digital native or that's, analog. You're signing a digital passport or representation of it. What's exciting is usually and historically the CFTC, Commodity Future Trading Commission, and the SEC, typical bureaucratic battles of whose jurisdiction does this fall under versus that. So they couldn't even get along to decide who was supposed to be overseeing this, that, or the other. Under this administration, the benefit that's happened is, one, you have a friendly SEC that has come out and said that these things are not securities, they are strictly commodities. Fantastic. They ceded authority to the CFTC, so the CFTC says, commodities, that's us, we got it. So instead of fighting over who's gonna oversee, they are deferring to each other. So just these little things have unlocked over the course of the last 6 to 9 months so much innovation building. I will tell you, a year and a half ago, I would sit with institutions and enterprises who could say, we have hopes and aspirations and plans to build all this stuff, but we will never do anything if we are on the wrong side of the non-existent line. What they mean is, we can't take the chance that we launch something and then wake up one day and be on the wrong side of the compliance line. Now we're out of the line. We would never do that. So nobody knew where the line was, if there was a line, if the line was coming, and what the rules were. Now it's like, you can do this, and it's not comprehensive. So with stable points, the Genius Act passed, which stated what you can and can't do with stable points. Just that alone opened up so much in terms of payments and cross-border remittances and a million other things. The Clarity Act may or may not pass, but even if it doesn't, just the fact that we have general rules and general guidelines. I have people that used to tell me, I want to do this in 12 to 18 months, coming back and say, how do we do this in 3 to 6?
Let's hear it for John and Mike.